Friends, in this video I want to analyze one strategy at the request of our subscribers. The strategy is options buying. It would seem that what could be simpler than buying options? But the difficulty is exactly how to make money on it. All beginners who start trading options first buy options, but then get disappointed with these purchases because they suffer losses and then move on to selling. Yes, beginners think that selling is a universal strategy, a constant cash flow and so on, but that's not what we're here to talk about. I want to talk about buys and how to make money off of them. And I mean the simplest ones, naked option buys. Let's get started. We open up an option chart and we're gonna pick a series that expires in a week and a half. We're going to work with Bitcoin options. So Bitcoin is up now. It's at 48,500 and you want to play on the fall of Bitcoin. For example, you take put options at strike 45,000. Expecting that in a week and a half there might be a Bitcoin fall that will make you profit. For this example, I will work with 1,000 contracts, which is 1 Bitcoin. After clicking on the T price, we can see that we only spent $235. Now, let's imagine that your scenario has come true. The Bitcoin price has fallen and reached the level of 45,000. Or even 44,000. But then what happens? The price turns around, bounces back and goes to the 46 or 47,000 level. You were partially right that the price would fall, but you didn't take your profit in time. You could have sold those options at the right moment, but something happened, you weren't at your computer, you didn't have time to close that position. You keep waiting, thinking that the price will fall, but it doesn't. It only rises, and the time decay destroys the profit for your options. Expiration happens, and you take a loss. This situation could have been avoided if you have done the following. Since buying options is by itself a gamma-positive strategy, so when the price falls, for example to 44,000, we could do the following. Since our delta has become 610, in this situation we could do a manual delta hedge. Manually. Let's start simple. So I buy 610 futures at 44,000. Okay, the price has changed, so I'm going to fix it. 44,000, yes. And that's it. I've already fixed the profit and got the delta neutral strategy, and now my potential profit is $1,600. What happens next? The price bounces back to the 47,000 level. I think this scenario is possible, but I'm not going to model it for you. You can do it yourself. Change the date. See how the P&L of a particular strategy changes. Now, to simplify the explanation, I will not go into these particular nuances. So, after the bounce, the price comes back to the 47K level, right here, and we get a positive delta of 350. What do we do now? Make the delta neutral again. And we manually sell 350 futures again at 47,000. Man, my price keeps resetting. I have to keep correcting it. Okay, our profit is now $2,219. And that's how manual delta hedging works, whether it is with put options or call options. But let's say that after that the price jumps to the 43,000 level. Why not? Halving is coming up, so anything is possible. The price went down hard. The delta is now 470, which means we have to buy 470 futures. That's exactly what we'll do. 470. 470 futures, so that the delta becomes neutral. Price 43,000. Correcting the price again, 43,000. and now our potential profit is over $3,000. These are the results we will get by neutralizing the delta with the futures as the price moves. I remind you that if you had done nothing, these options would have become worthless, losing their time premium. But we neutralized the delta, so we made $3,000 on the price movements, and the margin requirements are only $236. Once again, the main problem with all naked option buys is that trader failed to fix the profit in time and don't use delta hedging, not even the manual kind. As a result, options lose time premium and traders lose money. Such neutralizations of delta using futures are good to do when the asset price is at some resistance or support level. So with the help of the technical analysis, you can improve your financial result. But I remind you that all these calculations I showed only as an example. So this was the manual way of delta hedging. But now let's talk about the robot, delta hedger. So let's imagine we take an in-the-money option. For example, we bought call options with strike 48, 1,000 contracts. The delta is 580. We will sell. Well, we don't have to sell the whole amount. So we end up with some kind of a port straddle. We see the current gamma, so we understand what will happen when the price moves. If the price changes by 1,000 points, then since we have a gamma of 0.12, the delta will change by 120 points. And I'm not saying that it is strongly necessary to keep your strategy delta neutral. You can keep the delta positive if you believe that bullish factors are working right now and Bitcoin will rise. You can keep the delta in a certain range. For example, now I enter minus 280 and I will get the following delta. You can use a delta hedge to keep the delta in a certain range and fix the profit if the price of the asset rises. But you have to keep in mind that a fall is also possible, after which we will not get losses because our delta will become neutral after that. So an automatic delta hedger is a good solution. But an even better alternative is our rehedger bot, which prices the futures with a certain spread and fixes the profit from our purchased options. So our bought options become kind of a bought cow, and the delta hedger becomes our farmer who collects all the milk and meat. So these are the strategies I wanted to show you today. They are not complicated, you just have to remember that you can't just buy options and forget about them. You have to do some work. Either manually neutralize the delta by buying futures or run an automatic delta hedger or a rehedger. So please use these strategies, like this video, subscribe to the channel, and I wish you all the best and successful options trading.